Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now, with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello, I'm David Blain, and welcome to All Things Money. For the next 30 minutes, we're going to take an educational, stimulating, and entertaining look at your finances. We'll discuss everything from investing and taxes to real estate. Hopefully, we'll bring you some information and actionable ideas that will enable you to create or maintain wealth and achieve financial independence. The show is about you and your money, so if you have any questions or comments, feel free to give us a call at 252-633-0107 during normal business hours, or email us your questions or comments at any time at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And each week, one of the questions that we receive, we'll go ahead and send you a copy of our free quarterly newsletter, Financial Focus. Today, we're going to be starting a four-part series, what I call a mid-year update. We're going to be looking at the macro outlook for global markets and the economy. And then in future shows, we're going to be getting into actual outlook for sectors. It's been a very interesting year so far after the resumption of the bull market after the end of March last year. And so we thought it would be appropriate at this time to just kind of take a look at where we are and where we think things are going. So for the next couple of weeks, we're going to focus on the economy and the markets. The first thing that we want to talk about is using the Standard & Poor's 500 as a proxy for the stock market. Let's take a look at the moving average, specifically the 200-day moving average. I know that stocks have been in a decline since April. They've basically been going down somewhere in the order of, depending on which index you look at, somewhere around 10 to 11%. So what we try to determine is this something that the investor should be concerned about? Is it continuing to go down, or is this just part of the normal ups and downs of the market? Well, if we look historically, typically in an average year, there are declines of more than 10%, and so it's not out of the ordinary to experience it. Some years are more, some years have none. The period 2003 to 2007 was very calm, but as we reached into 08 and 09, there have been several periods of greater than 10% declines, and historically we see that. And so one of the things we look at is the 200-day moving average, which helps smooth out the day-to-day fluctuations in the market, which we feel there's absolutely no information of value contained in the day-to-day fluctuation of the market. As you move out to a 200-day average or a 40-week average, it helps to smooth out the day-to-day fluctuations, and you can kind of get a feel for the overall trend of the market. There's two things. Number one, you look at the actual level of the average. What is the level of the 200-day moving average? Currently, the price is below that moving average, meaning that the price has declined below the average of the past 200 days. However, the moving average is still moving in an up direction, meaning that each day the moving average moves higher, even though the market is declining. And I don't want to go into the specifics of how exactly this works, but suffice to say that you have both the level of the average as well as the direction. When we look at the direction, historically, when the S&P 500 200-day average is moving in an upward direction, the index itself has gained an average of 7.5% per year, and this is since 1929. So this is a long-term statistic. When the 200-day moving average is falling, typically we've seen an average gain of 0.2%. So right now we are still in a rising environment where historically this has been positive for stocks. So we don't want to get too panicked about the decline yet. It's still well within the normal variation up and down of the market. Do I think we're going to go up another 40%? like we did in 2009? Absolutely not. That's probably not going to happen. But at the same token, we don't feel that we're going to have another repeat of 2008. One of the other things that we look at not only is the level of the market, but volume. We've talked about this before, is if you have markets going up or down, but there's very few participants, it really doesn't reveal a lot of information. And so we look at once again, the moving averages of volume, and we see that the moving average volume is trending significantly upward. So the volume is increasing in the market significantly. The volume can be good or bad. If the market is going up or down, it makes a difference. When we look at the actual trend of the volume, we see that the upside volume is actually much more positive than the downside volume is negative. So what does all this mean? It means that the market is still in a longer-term upward cycle. Volume is increasing, which typically is found in rising markets. And we see that on days where the market is going up, the volume, on average, is still much higher than the volume on days that the market goes down. So these are somewhat positive things. When we look at the world as a whole, we're going to shift now from just the S&P 500, which is a U.S. index, to the Msci World Index, which tracks countries around the world. We see that the percentage of markets that declined below their 200-day moving averages in June, we had only 34% of the markets around the world above their 200-day moving averages. However, 95% of them were still, the moving averages were going up. So what does this all mean? It means that within this longer-term upward movement of the market that we have had a correction. And until these longer-term indicators start to go negative, we will still give the upward trend, the benefit of the doubt. The last thing we're going to talk about is one of my favorite, which is the sentiment poll, where our friends at Ned Davis Research, they track the sentiment in the market. And the sentiment met a relatively interim short-term pessimistic mark of only 46.6%. Of the indicators were optimistic, meaning that most people were pessimistic. Typically, when this indicator reaches pessimism, the market goes up by an average of about 10% per annum. So we'll finish up with that when we get back from the break. But for now, we're going to pause for a commercial break. For All Things Money, this is David Blain.